A common sense you don't want to miss. Craig Bolanos, the CEO and founder of WMG, is here with how to make the most of the market ups and downs. Craig, investing is not always as simple as putting investment money into the portfolio and letting it sit. Explain why rebalancing your portfolio matters.
So yes, Angela, portfolio rebalancing is critical if you want to get the long-term results that your financial plan calls for. Because when you start investing, you begin by outlining your goals, and that typically leads to the adoption of an asset allocation strategy. I mean, for example, some investors might have 55% of their portfolio in stocks to fuel long-term growth, another 40% in bonds to generate some income and create stability, and then 5% in cash to cover short-term needs. But over time, all asset classes move at different paces, and if there's not a way to rebalance periodically with discipline, you could end up with far too little or far too much stock exposure, and that could threaten even the best well-laid financial plans.
What would be an example, for instance, during the past couple of years of maybe putting in more cash into the stock market or less that could have worked well?
Well, Angela, yeah, portfolio rebalancing is all about improving your returns at the same time doing proper risk management. Because again, if you don't rebalance your portfolio, it's going to drift away from its initial asset allocation. Again, as an example, the stock market had great returns in 2020, 2021. And if you didn't rebalance the stock portion of your portfolio, then you likely got crushed and you forgot to ring the register by taking some profits because the dark days of 22 weren't good for anybody. And likewise, if you didn't have a plan to get stock exposure back into your portfolio in 2022, then you might have underperformed what your portfolio called for when the market had a strong rebound in 2023. So I think, Angela, really what we do is we talk about how to rebalance, when to do it, and here's what I call the 3 T's. That's right, 3 T's. Number 1 is time. The simplest way to rebalance a portfolio is just using the calendar year. Whether you rebalance once per quarter, semi-annually, that's an option, although I don't think it's an ideal. Part number 2 is to use a different T. I call it tolerance. And a tolerance would mean this: anytime an asset class in your portfolio drifts by more than 20%, you make a change. So if you have an allocation of 10% to small caps and small caps grow to 12% of the overall portfolio, time to ring the register, take some profits. Likewise, if you have a 10% dedicated to small caps, but they underperform and are now only worth 8, it's a great opportunity to sell winners elsewhere in your portfolio and repurchase the small caps to get back to your current weighting. What's the next T? If it's not time, if it's not tolerance, it's taxes. You gotta minimize the potential tax impact when you're doing frequent rebalancing. And that means in taxable accounts, making sure you're doing tax swaps on the fixed income side and tax loss harvesting so you can be efficient and start keeping more of that through which you make. Bottom line in this whole discussion, Angela, it was great that we talked about portfolio rebalancing. It's just critical. If you want to get retired and stay retired and optimize your results, you got to have strong rebalancing protocols to support your investment discipline. I'm Craig Bolanos, the CEO and founder of the Wealth Management Group. We have a history of providing investors with robust services, including rebalancing with strong tolerances. If you want to learn more, you can. Go to our website. That's investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.